You know, in your seat today, I think you probably have two questions. First, what the heck is a bond, and why do I care? And one of the biggest misperceptions that I get working in surety is that it's insurance. I work for an insurance company, so that is a pretty reasonable misconception to have. But the products are really different, and the best way for me to explain to you what surety is to go ahead and talk about how it's not insurance. Insurance, let's think about it. So I'm a mom of 2 boys, and when I was pregnant with our second, I was in the hospital with my husband. I had literally just given birth, and I said, we need a minivan. So he went out, he left the hospital, he went out to J. Wolf Honda, and he got us a Honda Odyssey. I love minivans. I think they are extremely practical, they get the job done. If you have kids and you have a minivan, you know, it's like you feel cocky when you're opening the sliding door and you get your kids out of the car seat with the diaper bag and someone next to you can still even get in their vehicle because you just slid open, right? Like somebody with the SUV, big door. Minivans are great. So what do I do to protect my cherished Honda Odyssey? I buy insurance. So I call my insurance company and they go through and run some specs on, you know, I'm a married female, my driving record. Come on, you can sit in the front, that's fine.
Thank you.
They run the specs, you know, where I live, have I ever had an accident, all that stuff, and they spit out their insurance premium number. So that's getting automatically deducted. I don't really think much about it at all until, bam, I get rear-ended on my way to work because someone was texting and driving. So what do you do after you have that accident?
Catch on fire.
That's actual footage from It is not. So what do? You have an accident, you call up your claims adjuster, and then they cut me a check. They come out and assess it, they cut me a check. That's a 2-party relationship. There's the insurance company and there's the insured person. Surety, on the other hand, is a 3-party relationship. Let's look at an example. I have this wealthy friend, we'll call him Ross. So my buddy Ross wants to get coffee, and he's gonna go out to this lady Rachel at Central Park, but he doesn't really know anything about her. So before he signs his contract with Rachel to get coffee, he says, Rachel, you need to give me a bond. And Rachel, she's like, okay, a bond. Well, let me call my buddy Chandler, because I know he's in the surety business. Chandler's gonna get me a bond. So she calls up Chandler, and Chandler's like, yeah, I know Rachel. She's been slinging coffee for years. She always delivers a successful product. People are happy. She's paying people on time. I'm gonna vouch for her. I'm gonna stand behind Rachel, and I'm gonna give her that bond. So Rachel can take the bond to Ross, and he has an assurance from an independent outside third party that Rachel is good for her word. Now let's say Ross, on this project, he had to borrow some money from his sister, Monica. We could look at her like a bank, right? So Monica is lending Ross the money, and Ross still is the one with this contract to Monica, or to Rachel. But Monica is like, I have a lot of money on the line. I kind of want people to know, like, I'm a party to this agreement. Monica's not changing this from a 3-party agreement. Monica would just say to Ross, hey, you need to put me on the bond as a co-obligee or a dual obligee. So if you ever hear that language, see that language, that's what the bank is. They're not a separate party. Monica doesn't have her own contract. She's just saying, if something goes wrong, I need Chandler to know I have skin in the game. She's going to be named as an equal party. And when that contract gets fulfilled, when Rachel fulfills it, Monica's over, you know, she's earned her interest and that obligation's been fulfilled. So she, again, the contract is not running to Monica, but she benefits from the completion of it. So she's like a co-party, and again, you'll see it called a co-obligee dual obligee or sometimes multiple obligee if there's other people involved. I don't want to leave any of our friends out. So Rachel, she owns her coffee shop, but she is not the one doing the work. She subs out that labor to her friend Phoebe, and she buys her coffee and her equipment from her other buddy Joey. Her bond that she got from Chandler, again, Chandler has vouched for Rachel. If Rachel just up and leaves and doesn't complete that work, Chandler's saying, hey, I vouched for her, now I'm gonna step in. I'm guaranteeing that contract gets fulfilled to Ross. I'm gonna step in, I'm gonna pay Phoebe, I'm gonna pay Joey so that we have our supplies, the labor is done, and the product, that cup of coffee, is delivered to Ross. This works the other way where Rachel could require, just like Ross required her to have a bond, Rachel, let's say she doesn't know Phoebe, she doesn't know Joey, she requires them to post bonds from their own sureties. And that way, if Phoebe and Joey don't come through on their contracts, their surety can step in and help get her labor and her materials supplied so that she can meet her contractual obligation. Do people kind of follow that scenario? 2 parties insurance versus the 3 parties in surety. The whole reason that we have this in construction is to guarantee successful outcomes. No one can use a bridge that's not built. So we want to assure as an industry that our owners get a project delivered, the contractor is successfully completing that contract, and that the taxpayers are getting a product they can use at the end of the day. Because if you're paying a lot of tax dollars, you don't want to have an unbuilt bridge and not be able to commute to work. Let's go through how this works for a typical construction company. Let's see if we want to. Yeah, before we go on to our construction, who pays for the bond in this scenario? Rachel pays for the bond. Ross wants the bond. It's going to benefit Ross. Rachel is going to pay for the bond. And the way that ultimately she can build that cost into her bid for Ross, but she is required to go out, find a Chandler surety, and then pay him. He's going to invoice her for his work. She's going to pay that. Rachel, the way that I like to equate that is if I'm going out and I want to rent an apartment, the landlord's going to say, you need a credit report. I'm going to go pay for a credit report from Equifax or whoever to give to the landlord to prove my creditworthiness. So a surety company or the person like Rachel who's benefiting, she's going to be paying for the bond that shows she is creditworthy, for that independent evaluation, just like you pay for a credit report. Kind of like the surety world's equivalent of an AM Best rating. If she gets a bond, we know that someone else with assets is backing her up and saying that she's good for her word. All right, so now the construction example. I'm Lindsay's construction company, and I have a contract with the city of Wichita to build a skate park. So my surety company, I'm going to say I need a bond for this skate park. My surety company is going to give me the bond, and it's going to guarantee to the owner, the obligee, the city of Wichita, that I'm going to complete the skate park. I'm going to pay for that bond. Again, I can build it into my cost, but that bond at the end of the day is guaranteeing the city of Wichita that I'm going to come through on my obligation, because the surety company, who has specific expertise, has thoroughly vetted me and says, yes, we've seen her do projects before, we know she can complete it, and we stand behind her. We're putting our financial assets behind her operation. One of the things I was thinking about just yesterday that I hadn't added to this presentation, if you were in the keynote, you heard him talking about capital and how you want to be able to use your capital and have more capital to build things. And I noted that because a bond, there's a cost to a bond, but let's say Lindsay's construction company, I have 5 contracts with the city of Wichita, 5 $5 million contracts. I could go out and post an irrevocable letter of credit, an ILOC, for $5 million, guaranteeing that I have the assets to protect the taxpayers. But if I have to pledge $25 million of my cash in ILOCs, that doesn't give me enough cash at the end of the day to pay my payroll. The cost of a surety bond is going to be very minimal. Let's say for $25 million of work, I'm paying $200,000 of bonds, which again, I get to build into my bid estimate and cash flow back to me. That gives me a lot more capital that I can go out and build other projects because all my money isn't tied up in credit guarantees. People follow that one? Okay, so it just, again, expands your capacity. In construction, cash is king, you need your cash flow, you're making payroll, so it gives you that ability to do so. And just like Rachel, I might have my subs, so when I go bankrupt or don't pay them, my all mixed up concrete and my mulch-a-do landscaping, the surety company is gonna come in and pay their bills so they can actually build that skate park and deliver a successful project. And it's ensuring, maybe in this situation I ran into trouble and couldn't complete that job, but even though I couldn't complete it, it doesn't hurt my subs. They're still getting paid, and those lower tier subs and suppliers have protection, and they're gonna succeed. Just because a general went out, it's not gonna put them out of business. All right, so everything that I've talked about up until now is contract surety. And there's sort of the larger surety umbrella. Contract surety are bonds. Under that larger umbrella, there's also commercial surety. Contract surety, in the industry, we always call that sticks and bricks. It's anything that you're building. Commercial surety is really guaranteeing a promise. Someone like Chandler is guaranteeing that Rachel is going to do what she promised she would for Ross. One of the examples that I like to give to demonstrate commercial surety is we are in the city of Wichita and there is a city treasurer. I looked up who that is and it said there was an interim, that there's no one in that position right now, so there's an interim guy named Rob. If you know Rob, this is just a hypothetical scenario. This has nothing to do with Rob as a person. But Rob is going to have to post a surety bond, and his commercial bond, his surety is going to evaluate his character, evaluate, okay, how long has he been a treasurer, what's his credit score, does he have past bankruptcies, things like that to try to know who he is as a responsible money manager. And they're going to, at the end of the day, say, yep, he's vetted, give him a bond, the city's protected. But Rob had a lapse in judgment, and he started taking funds from the coffers, going on vacation with his wife and kids, and at the end of the day, there was $1 million gone. That bond is guaranteeing that instead of the taxpayers being out $1 million, the funds will be covered, the city gets made whole, and things like parks and potholes and all that road construction can still get built despite someone misappropriating funds. You might hear that called an honesty bond, and really a faithful, it is just guaranteeing that someone is faithful and honest. And that's what the surety company is pledging their assets to back up Rob or whoever it is, their ability to fulfill a promise. And again, people do embezzle. Like Vicki mentioned, I had someone embezzle from our small surety association. Things like that do happen, and again, that bond is just protecting the taxpayer's dollar. So I want to point out one thing that we didn't cover yet, indemnity. Does anyone know how indemnity works in bonding? a couple people are maybe familiar. So the surety is not just a really financially diligent, pinky promising organization. We want to know that we are protected, and the idea of personal indemnity is extremely important to how surety works. When Rachel gets that bond from Chandler, yes, he's vetting her, but he's also having her sign a personal guarantee to say, yeah, if I cause you a loss, Chandler, I personally owe you that money back. So Rachel, in that term, anyone signing the personal indemnity agreement is saying, not just, do I want you to believe in me? I believe in me. I'm gonna sign personally and say, yeah, I know that my company is capable of this enough where I'm gonna sign away my personal guarantee to you. And it just gives the surety that extra faith, like you really do have skin in the game and you're dedicated to your company and your product. Again, the surety, a person could, you might wonder, like, why would they sign everything personally? If they're just gonna have to pay back the loss at the end of the day, why does it matter to have the surety? That's where that capacity issue comes in. If I am, so again, let's say I have $5 million contracts to the city of Wichita. I don't want to put $25 million of my own capital at risk. I'm asking someone else, I'm asking Chandler to put $25 million of his capital behind me, and that's at risk. But I'm saying, all right, Chandler, that you're doing me a favor here. I'm gonna go back and sign this personal indemnity agreement because I don't think there's a chance I'm gonna cause you a loss. And if I do, I'm willing to make that promise and pay you back and make you whole for it. And again, Chandler is getting added assurance by having you sign personally that you're standing behind your product. Yeah.
So on personal indemnity, can you explain too, because I know this question gets asked a lot, why the spouses also have to sign that personal indemnity agreement? And the spouse might not have anything really to do with their business.
Which is oftentimes what we see. The spouse isn't involved, maybe the spouse has their own separate business. It's just a form of protecting us when there is a loss. So the money can't be, all of your construction company or personal money can't be funneled away and put in, Mr. Wing's bank account. And I'm like, well, that you have me just signing, not Mr. Wing, and I give him all my money so that maybe I don't have to pay something back, or I can declare bankruptcy. But kind of along those lines too, you might see if the spouse does have a separate business, they can exclude that business because a spouse might not want their other spouse's business decisions to impact their own business, and you can carve out things in personal indemnity. Another thing you might see kind of on the technical side is limiting that amount. You might say, yeah, I'm personally indemnifying, but only up to a certain dollar amount. That comes with time and with trust. The surety company, they're putting a lot of their faith in your abilities, so they want to make sure that they know you. And again, personal indemnity, it's a really good way to say I stand behind my product and who I am and what I can deliver. The surety company is going to want to know other things about your character, and the indemnity is just a good way to measure character. But
and if you have more than one business owner, like if they own 25% or 10% of the business,
you definitely want
you're
to
gonna have each of those partners.
Yep, usually on a surety indemnity agreement, if someone is more than 10% owner, a lot of companies will have maybe partners, 3 owners, 4 owners. If you own more than 10% of the company, the surety is gonna want you signed on because you have that skin in the game, you're an invested owner of that company, and they'll have multiple people sign. Kind of like if you are, let's say Lindsay's construction company, I own another LLC that owns my building and it owns my equipment. The surety also wants that indemnity of any of my other LLCs or organizations I might have. They need to see the whole picture because they're putting so much of their financial assets behind you, backing you. They want to know that they're protected in case there is a loss. And construction, construction has a 25% failure rate. So it's an extremely risky business, and we need to do a lot of diligence in our underwriting to really understand the ins and outs of someone's business to get comfortable with it. Surety companies, I have a very close relationship with my clients. I want to know, how are their operations? How are their internal controls? What types of jobs are they bidding? What's their plan going forward? I meet with my contractors annually. I try to get a really good understanding. Again, kind of like that keynote. What's your vision? Who are you? What are you doing? I want to understand that because I am a partner, and our surety organization is putting a lot of our assets behind you, or really backing you. All right, now we're going to do a few examples where you guys can try to be underwriters. So pull out your phones. And now we're going to see if my tech works too. So, okay. Has everybody gotten, what'll happen, you'll text Lindsay Wing 437 to that number, and it'll just send back and say, hey, welcome to Poll Everywhere, I think is what you'll see. Did that happen? Okay. Raise your hand if you got a response back yet. Give you guys a minute to catch up on the tech. I don't know how the service is. Do people have service in here, cell service? Who hasn't gotten a reply by text after texting this in? I think everyone. Can you see in the back? It's Lindsay Wing 437 22333. Subject Lindsay Wing 437. Send. Okay. Anyone not in yet? Okay. Here in the way back, is it hard to read back there?
It's just that I'm blind.
Send it to that and that's the same. I know, tech is hard. I was like, am I being too avant-garde here, going with text polling? I don't know. All right. So you'll do 2 in the subject line, 22323, and in the subject. I think that's most of us right now. We'll go from there. There's going to be a few examples, so if you're not in yet, you got some time. Okay, hopefully I've gotten this active. All right. So, and really what this is meant to point out is maybe what sureties consider red flags or things that we look at a little bit differently, and also that there's a lot of gray area in underwriting because, again, that keynote kind of resonated with me. He was saying some people say it's a gut feeling. Surety is not really a gut feeling, but over time you do get that experience that gives you a pretty good idea of how you want to go on a risk. Okay, so let's say we have two companies, we're going to have two companies. They both want to bid a $10 million wastewater treatment plant upgrade project. Two companies, they both want to bid a $10 million wastewater treatment plant upgrade. First company, y'all can read this, 15 versus 25 years, their largest job complete, personal credit score on the owner, the project location. Some of you in the back probably can't read that. So project location for contractor A, it's within their territory. Contractor B, it's a neighboring state. Profit history on contractor A. Majority of their jobs close out profitably. Contractor B, a few jobs showing losses. So you can look at all those, and if you think you'd be more likely to give that $10 million bond to contractor A, you're gonna type A, send. If you think it's B, type B, and then send. All right, so think about those, okay, years in business, 15 versus 25. What's the size of your prior jobs? How's your credit score? All right, have people sent in their responses on that one? Text A or B? You got that? All right. I get the answers up here too. All right, so in our audience, most people say contractor A. Can I ask for anyone who picked contractor A, what made you go that way? Anyone want to volunteer that?
I'm saying the last statement where his last few jobs were profitable, and just because he wasn't in business that long, that doesn't mean he doesn't have the experience.
Yep.
And, his credit rating, that didn't bother me none.
Yeah. Anyone else?
Largest job.
Local. So all of those are factors that way you can all do my job now.
That easy, huh?
Yeah, it's so easy, right?
And it was all gut.
Demystifying
It
surety.
was all gut.
Right. Always just go with your gut, ignore the facts. Yeah, on this one, 15 versus 25 years, not a big deal. If it was 1 year versus 15 years, that makes a difference. But once you've got 15 years under your belt, the next 25, 35 is probably not going to make or break your experience. This here, you mentioned the few jobs showing losses, and that's a good underwriting indicator. That would be maybe what we call, again, a red flag. But in all honesty, I've never underwritten a contractor, I've never written a bond for a contractor who didn't have losses. We know, again, construction is so risky. Things are going to happen. There could be a bad owner, a bad sub. There's so many variables that it's really likely that we have some jobs showing losses. And also, I kind of just worded these two different. Majority of prior jobs closed out profitably, so they had some losses too, right? Contractor A did. And like a couple of you hit on, the largest job complete was 8 million versus 3 million. This is huge for surety underwriters. If you've only done a $3 million job and you come to your surety and you say, I want to build, even if it's the same owner, it's a wastewater treatment plant, it's in your backyard, the surety company's going to look at that with a little bit more scrutiny because it's really hard. One thing we hear a lot is, oh, it's just more of the same, but bigger, just twice the size. 3 million to 10 million, it's almost an exponential degree of difficulty curve. So an underwriter would prefer to see a contractor stair-stepping it, working up to 3 to 5 to 7 and then 10, because there is that risk. And an underwriter is trying to be a partner to a construction company. We don't want you, again, we're trying to guarantee a successful outcome for everyone. We don't want you to get on a job that could be something too difficult. Because most likely your surety underwriter has seen a lot of bad jobs happen. They have a lot of experience and knowledge, and they know, hey, 99% of times, 89% of times, whatever it is, that I've written a bond for someone that was a big stretch, it didn't turn out well. 3 to 10, you could argue is not that big, but 3 to 15 or 10 to 50 million. It is a big factor. So you guys, you nailed it.
Especially if they've been in business 25 years.
Yep.
And their largest job's 3
Yep.
million.
Yeah, and again, it's other factors that we look at. yeah, are they changing their business plan? I don't know if that's where you're going with that, but if they've been in business 25 years, they're always doing $3 million jobs, and 10 million all of a sudden is like, well, what, are you trying to grow? Is there a new direction? We kind of say, what's happening? We are your partner, we want to know your vision. If your vision is to grow, we want to help you do that profitably, and again, successful outcomes. So surety industry, we're partners, we want to see successful outcomes. So yeah, that's a good point too. Okay, now I think I have to go back into my tech. We're going to do another example. I'm going to activate this for you. Okay, so scenario 2. It's a $40 million high school renovation project. Contractor A is a general, B is a drywaller. A, profit history, they lost money in 15, 16, and made money in 17. Contractor B, they have never lost money in their 40-year history. Contractor A, their largest job is 30. Contractor B, it's 40. And A and B both personally indemnified their surety company. Okay. I think it maxes me out at 25 people. I think that's just about everybody in this room. If you're the last person, your vote doesn't count. All right, 16 people, 17. This is a closer one. All right. A little bit closer, right? Most people thought contractor A, but a lot of people were on team B. And again, let's go back to this one. So people, why did you choose what you chose? What on here made you go with your decision? So how about somebody who picked B? That was the second runner-up.
Everything but the fact that they were a drywall contractor was better on paper.
Yep.
So the concern would be that they don't have experience in that type of work. The opposite would be they're more financially viable.
Absolutely. Yeah. And how about the A team people? You guys voted. There must have been some reason. What about contractor B? They never lost money. Contractor A, why do you vote for them? They lost money.
He's not taking on the big. He's not taking on the big chunk. The general contract, he's dealing with 80 people. The drywaller guy's dealing with drywallers. You know what I mean? He doesn't have a lot of skin in the game. The contractor, he's the guy.
Yeah.
So I would say he would know a little more about renovating a school than just a drywall.
Yep.
Well, the drywall has never lost money, so.
I think A goes back to your company vision. Obviously, they were not doing something right in 15 and 16. They've made some changes. They're moving forward. You're going to put trust that they know what they're doing as a general contractor and that they're continuing that upswing. But I think you have to ask more questions of some of it as well. Just have that discussion with them as a contractor. What is this change? Are we still on that path? Or are we going to revert back to where we were?
That's exactly right. You want to see, you might think, oh gosh, they lost money. They don't know what they're doing. You want to ask more questions and you want to find out. Maybe there was a lawsuit and they just had this totally unexpected, they had paid all these attorney's fees. Otherwise, they were profitable. And that's what we do in underwriting. We want to know the answers to those questions. A loss isn't necessarily a deal breaker. It's not like we know that, again, construction is so risky. Things happen all the time, and underwriters just want to understand why did it happen. And let's say, okay, maybe they lost $500,000 in 15, $100,000 in 16, and then they were kind of break even in 17. That's a trend too. That's a good trend we like to see. Or maybe they had been profitable or trending down. It was you lost money last year and you lost more money this year. what's going on? Are you cutting overhead? Are you working with different people? Are you reviewing the contracts? That's something that's extremely important and not always talked about. You know, we want to see if a contractor's good. I know so many contractors will say, especially in NAWIC, they're like, we had someone come in and talk about risk in a contract, and they said, how many of you as attorneys, like how many of you are reviewing your contracts, or are you just so excited to get the job that you're signing it and like running out the door with it, you know? A lot of contractors, you're just so glad to have a job that you might not see risk. And that's where a surety company can kind of be a partner and say, hey, listen, this McCarthy subcontract, it's really general friendly. You're gonna wanna see these provisions and either build some additional contingency in and factor in that potential risk, or see if you can change it. You know, some of it's hard. You're not gonna probably have much negotiating room with like J.E. Dunn doing a job with them, but again, price that risk and see, is this something to consider? And again, back to that keynote, that's valuable information. Are they aligning? I had never thought about that until listening to that presentation. Anybody else have any other thoughts or questions?
You want to ask B, have they ever acted as a general in the past? Because this is their first time acting as a general, they've got no
Yeah.
business doing it.
Yeah, like why
Right.
are you building a school job? Just work.
Stick with your bread and butter, the drywall, and just stay there.
Yeah, and yeah, exactly. Have them explain it. Like what's going on? Do you know the architect or? Yeah.
What about like even on contractor A, maybe they purchase some big equipment or something, how did that might factor into?
Drive along.
Yes. Yes.
Are you massaging the numbers? But yeah, and there's really, surety companies don't like surprises, we don't want secrets, you know, we want to be a transparent, truly transparent partner. Because we pledge our assets, we have faith in you, I want to make sure that my contractors are successful because they're delivering a product that people need and the taxpayers pay for. And there's subs whose livelihoods depend on doing that work, you know, and for the subcontractors that I bond, I want to make sure that their generals pay them. So we look at a lot of factors, we'll ask questions, and we want to, another thing we pick up, yeah, go ahead.
I was just gonna say, in scenario one, the credit scores of the owners, do those not play as big of a role since it is an overall company?
Yeah.
'Cause
Yeah, exactly.
I have financial background from credit unions, and we pretty much stay on credit scores. Because if you have like a 550, that means that you either buy everything in cash and you have no credit, or you don't pay any of your bills.
Yeah. For most, for a lot of underwriters, we'll look at, initially when we write a company, we want to know who the owner is.
Sure.
We'll pull credit. We'll see if you had a past bankruptcy, how long ago was it? Was it due to a divorce? You know, that's really common and sometimes out of your control. So the credit score is important
Right.
initially, but yeah, if I have a client I've written for 10 years and their credit score isn't great, it's not gonna make or break my decision because I know they've been successfully running their
Sure.
company. So, yeah. Or again, it's another place that you wanna ask a question.
Yeah.
Why is your credit score so low?
It just seems strange that they make profit every year, but their credit score is
Yeah.
really low.
Right. So yeah, was it a divorce and they lost everything and had to declare bankruptcy?
More of a case by case basis.
Yep. So again, yeah, you can kind of, I think you are probably getting the gist, like there's a lot of gray area, different factors. There's really nothing things that are derogatory, it's really where we're just asking more questions and I hope to get honest responses back to understand the business. All right, I'm gonna do one more scenario for you guys. Activate this one. So glad the tech worked. All right, we are a sub to a large general for a $3 million electrical package. Both of us, A and B, specialize in electrical. A has a new ownership, the prior owner died. B is the same owner for 40+ years, no succession plan in place. A, huge profits and distributions in prior years. B, moderate profits, leaving it in the company, growing their net worth. A, personal indemnity. B, no personal indemnity. Vote away. And also, just like the prior, there's not necessarily right and wrong. It's areas where you're asking other questions. You want to know why. Underwriters ask a lot of questions. Did someone raise their hand just then? No, okay. All right, this one has a little bit more definitive. People are more decided on one. All right, you guys ready to see the results? Most people thought contractor A. So again, why are you team A? Why are you team B?
Indemnification on A.
You like that they personally identify? Yep.
Yeah, that was a big, that would bother my gut.
Yeah.
But he's been in business or she's been in business for 40 years.
But
Yep.
the age and no succession plan.
My presumption is that A doesn't have much net worth, so the personal identity's indemnification is not worth a lot, because they just bought the business, so they're in debt to the former owner.
I guess I'd want to find more about the new ownership. Was it passed down? Are the project managers the ones that are really doing the work? Are they around and the ownership maybe not mean as much?
Yeah.
I presume B has a lot more equity sitting there to back up the contract.
Yeah. They're all really good, and this one, there's kind of not a right answer. You could make a case that both of these would get a $3 million bond. They're both specializing in electrical. What you might see is that, so the indemnity is a big thing, no personal indemnity. It's been the same owner for 40 years. So you might say, okay, maybe we've worked with this guy and only recently released his personal indemnity. He or she has, again, been a partner to us for decades, and the surety has a lot of confidence. That succession plan, though, is kind of a big deal, right? What would be the risk if you don't have a succession plan? Right? And a lot of construction companies are closely held, family businesses. It might be one guy or gal who built this thing from the ground up. And yeah, when he dies tomorrow, what happens? Not only that, just walk through this scenario. Okay, I own my electrical company. I've run it for 40 years. I don't have kids. I don't have a key man or woman. It's just me. I'm like this one-woman show. If I disappear and I'm out on, I've got 10 jobs going on, who makes sure they get done and that my people get paid? My people who have families of their own, they gotta pay their mortgage and put their kids through school. If I just disappear one day and the surety's gonna come in and have to complete those jobs, and then the surety is gonna have the right to the funds to complete the jobs, a surety company wants to know that you've thought about how you're gonna take care of your people in case something happens to you. Even with young owners, even in this case, a new ownership, prior owner death, we wanna make sure that new ownership is still thinking about that. The construction industry has a big labor shortage. You gotta be out there finding people who can come and take over your company if something happens to you. And you should probably think about that sooner rather than later, especially again with that shortage in labor. You need to find people who can either close down your operation and make sure everyone gets paid and can move on, or continue your legacy if something happens.
So who did you pick?
So in this one, in my mind, I was thinking B, but there's not, I don't think if my colleague at another company, Tom, said, I'm giving a bond, maybe they're gonna bid the same job, right? And there's a first and second bidder. They're both qualified, you know? Go with your gut.
There you go. There you go, we can do your job, there you go.
How do they see their people? Who do they wanna serve, you know? See
But
that.
even though there's no personal guarantee, you
Yeah.
still have that corporate
Corporate,
guarantee.
yeah.
So
And
if
I don't-
you're looking at financials and you're saying their corporate financials are really strong and, you know, they always need a profit.
Yeah, and they've left money in the company. They're making a lot of money, but they're taking it all out. So I'm thinking, well, are these new owners taking out all that money and then going and buying jet skis?
Yeah, they're
Boats?
millennials.
Yeah,
Yeah, they're buying stocks in Fitbit or
yeah,
whatever.
right.
Bitcoin.
I want-
Bitcoin.
I want that. I don't want them investing in. I wrote a contractor who had money. The construction company. He wasn't even personally. He was investing the construction company's money in silver futures. That's hugely risky. And when a surety company is backing you and your reputation and guaranteeing that you're going to succeed, we don't want you putting money in risky places. We like to see you having cash, growing your balance sheet, because we also know, I know, cash is king, right? You hear it all the time. It sounds ridiculous, but it's so true. No matter what is going on, a contractor has to make payroll at the end of the week. If you are tapped on your line and you're not keeping your profits in your company, you don't have enough cash. Whether you're, power-driven, profit-driven, or purpose-driven, you need to leave money in your company. You're not benefiting the people. Let's say you do want to grow, you want to be the biggest contractor, have the best reputation. You still serve the people who work for you, and you're not doing them any favors by taking all that money out and putting it in places that don't serve the construction company. The life force that is your company, you need that to be sustained so that all the people who work for you and their families and everything can go on with their day at the end of the day. And then the taxpayers get bridges that aren't half built, and the cities can have someone reliable that they're working with, and they know that they're delivering a product that is useful.
Well, like the speaker said this morning about the 3 Ps.
Yeah,
In surety, there's 3 Cs.
that's right. We say character, capacity, and capital. Character, that's like, hey, is Rachel like a good person? Does she pay her bills on time? Is she running her business okay? Capital, how much money are you leaving in your company so that you can fund your payroll? Capacity, do you have enough crews? Do you, to man your work that you have? We want to make sure all those things are accounted for. Exactly. All right. This is a slide that I copied from the Surety Information Office. And again, it's outlining the differences. We talked about insurance is 2 parties, right? We have the insured, I have an accident, they pay me money, and I get a new vehicle. Surety, we got Ross with a contract with Rachel, and Chandler is backing that up. That's 3 parties involved. Coverage, project specific versus term. So let's say I'm a contractor, I have a fleet of 10 trucks. I have one policy that covers all of my 10 trucks. I also have 10 jobs going to the city of Wichita. There's 10 separate and individual contracts and bonds for each job. The insurance policy is probably good for 6 months or a year. You have a term, right? Everything is covered within that term. The bond, it's just project specific. So once you deliver the skate park to the city of Wichita and they accept it, the bond is irrelevant at that point. I've delivered on my promise. I've completed a finished product. So the bond just covers all my other jobs that are still going are separate bonds and separate obligations. The 0 risk assumption is huge. insurance company, you know, Geico is insuring millions of other moms who drive Honda Odysseys, and they know there's gonna be car accidents. You can't prevent that to a certain extent. So they just spread their risk among a really big pool of people. But surety, we're not a builder's risk or a general liability policy. We're pre-qualifying, like that credit report, saying we will not write a bond if we think there's going to be a loss. So in any of those scenarios, and contractors A and B, if I am worried that contractor A or whoever the drywaller can't build that school project, as a surety underwriter, I will not give them a bond, because I wanna make sure that a project succeeds, that a contractor succeeds, that the school gets a successful project. That's writing to zero loss. I'm not assuming there's gonna be a loss. Both are regulated by state insurance. This last one is kind of interesting. So insurance, you can just purchase that at your whim to protect. I didn't have to insure my minivan, but I do. It's very important to me, and I want protection. Surety bonds, unless it's public and the statute requires that you have that bond, on a private job, a surety bond isn't mandated. It's really just an optional coverage you can get to mitigate that risk. Again, it's having that third party like your AM Best or your Equifax guaranteeing that, yeah, I independently evaluated Lindsay's construction company and I'm vouching for her. Those are just the blanket differences between surety and insurance. At the end of the day, we just want to guarantee successful outcomes for everyone. We want to be friends, we want to make sure that people come out whole, and the surety bond product, it's not insurance, it has a distinct purpose, and it is really, again, its goal is to guarantee a successful outcome for our contractors, for any of those subs, for owners, and for the surety company as well, and for the end users, the taxpayers. That's all I have. If you guys have any questions, I think we have, all right, let's see. We have about 10 minutes before the official, I think lunch starts at 11:45. It's 11:36 right now, so if you guys have questions.
If you're validating somebody's bond, where do you go to find an AM Best AAA rating, or how do you know this is a better bond or this other bond?
You can go to the Treasury listing. So I think if you just Google surety bond Treasury listing, it will give you the name of all the carriers and their capacity. And I think it will does it give like the AA or A+ rating on it?
It's on AM Best.
Just on AM Best.
The T listing gives the state that they're licensed in, their treasury capacity, and you know, whether or not they're on that list. And then the AM Best gives you what their paper.
And some surety has a lot of consolidation. Some companies will, because they've bought up other companies, they'll write on different paper. So Hanover Insurance Company, that's what I work for, they have another company called ASPE. I don't know if we still even write on that, but let's say that had a different capacity or a higher rating, we could use that in different circumstances. We don't like to see, some owners have started putting requirements that say you need to have like A+ paper. That's a little bit risky for an owner to require that. You know, A paper is typically good paper. If you're asking for A+, there's only a couple sureties who can write that. It's just gonna limit who can bid on a job, and then you're gonna pay more because you've reduced the competition. So that's something, if you do see that from an owner, you may wanna let your agent know, because the Surety Association will work with owners and say, hey, you're limiting competition, you're gonna increase your prices, if you do happen to see that. Anybody else? This is very high level, I did not drill down into details.
Is there a rule of thumb on private projects, when people typically require surety bonds, or is that board just kind of up to whoever the owner is? And
A lot of times it's driven by the lender. If there's a bank on the project, they're gonna be the one saying we want a bond because they understand that it mitigates the risk. Some private owners will, but I'd say it's more rare that you just get some private owner coming out and saying, yes, we want a bond. Their bank or their financer will require that.
About maybe on larger projects where you might want to bond back your subs.
Yeah. That's just like where Rachel, she can bond Phoebe and Joey because let's say if she doesn't know them and she knows that contractors have a 25% failure rate, she's like, yeah, I want you guys to give me bonds because I don't know you and I need to make sure that I get my coffee to Ross. So that bond means another surety has verified that you guys are good people, you're gonna get done what you said. And if you don't, that surety is backing you with their assets and they can come in and make you whole. So that's kind of how the bonding back of some subcontractors. A lot of generals will, they'll require a sub they've not worked with. If you work with a certain gen, if you're a sub and you work with them a lot, they're probably not asking for a bond. But again, it mitigates that risk if it's a sub that you don't know. You're in Wichita, they came from Texas, they're working on a project, you have no idea who they are, the people in your circle don't know who they are. You probably want to get a bond from them to protect yourself there.
Does the bonding company sometimes require the general or want the general to get the subs bonded as well?
They sure can, yeah. If I'm, let's say it's that $3 million job, or that the largest one that you've done is 3 and you want to do 10 in that example, and you're like, well, the job is 10 million, but 5 million I'm going to be subbing to the mechanical guy. Like, okay, we'll get a bond, and then we know that that protects half of the job is going to be protected by a surety bond. So yeah, a surety may ask that, and it's just protecting that contractor who's only done a $3 million job and now they want to do 10. It's going to protect them too. We're trying to guarantee a good outcome for them, and having that bond, if the shit hits the fan, it does give some guarantee there.
Is there like a typical loss percentage if the surety does have to come in and complete the project? It's a $40 million project, they normally lose 10% of that, or 20%.
Ooh.
I'm sure it depends upon how far the project is along,
Yeah.
size.
It does depend on how far along. Obviously, if a job is 50% complete versus 90% complete, it'll have an impact. I don't know if there's a specific number, but I did read something recently where we look at a contractor's program as their cost to complete, and the Surety Association had done some compiling that when they pay out, it's more like the bonded exposure. So let's say it's 20 million cost to complete on a $40 million job. The Surety Association has found that they're paying closer to 40 million. And that's a weird, you are getting a bond, a payment and a performance bond. If you have a $40 million payment and performance bond, we talk about that as one thing, but we could pay out 40 million on the performance part and 40 million on the payment part. So it's $80 million of protection, because we gotta pay your first tier subs and suppliers, and if you just walked off the job, we've gotta hire somebody else to come in and complete it and pay their subs and suppliers. So it's, you'll hear it, hey, I need a bond. If you're getting a performance and a payment bond, that is protecting the payment of your materials, your sub suppliers, and the completion and performance of the job. It's kind of it's one bond, but it's two separate coverages, if that makes sense.
How does your selection process change from a statutory bond or performance bond to a maintenance bond? Are you looking more at that character and their longevity. City of Wichita requires a 2-year performance and maintenance and statutory bond.
Yep.
For anything that's publicly owned and maintained.
Yeah.
And so I'm just curious what your analysis of an underwriter, how does that change, or is it the same for the different bonding factors?
That's a good question. It's standard to see 12 to 24 months warranty, so most sureties, we're just gonna write that pretty freely, we understand. Did I say 12 months to 2 years, 24 months? Some places will require like a 3, a 4, a 5-year maintenance bond. A 5-year is going to be harder for us because latent defects happen, you know, after 5 years. There's only so much that you could have done as a general contractor. If you installed something properly, the problem's probably going to happen within that 2-year window. So that's a 2-year is something that we'll commonly see and write bonds for. Does that answer
Sort of,
your question? What did I not?
No, it's just that, I'm just trying to think through like the difference between, and maybe it's just the title, maybe they're all equivalent,
Yeah.
but is there a difference in what you're looking for as an underwriter? You know, for the performance side is really just making sure that everybody does their work, but the maintenance side really goes back to the quality of the work the first time. And do those pay out differently, or is that really, I mean, because it really goes back to the owner and how the owner is enforcing them.
Yeah.
And requesting.
Well, that's a good point too. Personally, I've never looked at something and considered how my contractor, I guess it's not been a big enough area of risk for the surety world in general, where we view that. When I underwrite a $10 million school job, as long as it's not a 5-year warranty, if it's 1 or 2 years, I kind of just ball that into the same risk and look at it as one risk, if that makes sense.
Yeah.
If you were having, I guess I would think if you had, and a lot of contractors on their WIP, they have that line item for maintenance work. If that was eating up all your profits, I'd have some questions and want to know what's happening. But otherwise, yeah, we kind of look at the maintenance as just part of that initial obligation. Yep.
So what if somebody fails and has to utilize a surety bond, what are their chances of getting another one in the future? Slim or none, or just kind of, they gotta build it back up?
It depends. Yeah, you gotta build, a lot of reasons, you know, again, with that 25% failure rate, there are a lot of things that can go wrong, and a lot of that is outside of a contractor's control. If you were just terrible at managing your company and never made money, we could see that in the financials, in the work in progress. But let's say again, it was something outside of your control, you had legal fees, a surety company came in and paid out a loss, and then you paid them back because of your personal indemnity, you made them whole. You could get through that. You might move to a different surety company, we call that surety fatigue, you know, where you get tired of like going on with somebody always having issues. But it's not a deal breaker, especially if they say, well, this company personally indemnified, they made the surety whole, they did what's right, their character is very strong, and it wasn't a factor that they could have controlled. That owner, a general, in the UK, Carillion went bankrupt, that was one of their largest contractors. They estimated like 46,000 subcontractors and suppliers were impacted. They don't have bonds in the UK. So when Carillion went bankrupt, there was no protection. So if that puts a sub out of business and they cause a loss, this is kind of out of their control. Anybody else? Okay, thank you guys so much.